Hello everyone, welcome to mangomonkey Learns Money. So today I will be talking about why Warren Buffett never sells stocks. One reason is that he actually is a long-term investor. That's not a secret. Everybody knows about that. Because when you have something good, you don't want to let him go, right? If you have a good husband, you don't want to let your husband go. You want to keep him. So the same goes for stocks. If you have a good stock, you don't want to let it go. But another reason is that if you sell your stocks, you realize your capital gain. So in most countries, the capital gains tax is levied when the stocks are sold. And that's certainly the case here in Australia. So if let's say your profit is 10%, your tax is let's say 30% of the capital gain. That means your tax is 3% of the value of the stocks, right? So your return goes down from 10% return to only 7% after tax. If you start off with $100 and let's say you wait 20 years, you will have $387 in 20 years after tax if you sell your stocks every single year. And every single year you achieve a rate of return of 10% before taxes. Now if let's say you never sell your stocks and that stock happens to also grow at 10% per annum every single year, in 20 years, after you pay your 30% tax on your capital gain, you will have $501. So you go from $387 to $501, which is almost 30% more. Why is it a lot more even though you are paying the same tax rate of 30%? It's because by delaying the payment of the tax, you get to keep more of your money for the bulk of the 20-year period. So you pay your tax at the end, and during that time, you keep your money and you actually invest your money that you keep. And because of the effect of compound interest, you earn money on this money that you keep. So when you end up paying your tax, in 20 years, you have much more remaining on your side. What's even better is that here in Australia, the Kangaroo Island, we have what's called discount capital gain. What discount capital gains allows us to do is to actually pay tax on only half of the capital gain. So for example, let's say your tax rate is still 30%. If you keep your stocks for one whole year, minimum 1 year, you pay tax on half of the capital gain. So let's say if you make $10, your capital gain is $10, your tax will be based on $5. So it's going to be 30% of $5. In other words, it's something like 1.5% of the original investment. One other complication that you should keep in mind is that if you do sell your investments after 20 years, your capital gain is likely to be a very massive figure. It's going to be very large because you've waited 20 years and you realize 20 years worth of capital gain within 1 year. So what will happen is you will be on the top marginal tax rate in Australia. So your tax rate will be something like 50%, not 30%, it's more like 50%. So let's have a look at what happens. If your tax rate is 50%, you get the discount capital gain. Is it still better or is it going to be worse compared to if you sell your shares every single year? So if you sell your shares every single year, we'll assume that your marginal tax rate for that year is only 30%. Because you are an average salary earner, so you're not on the top marginal tax rate to begin with. So after 20 years, we'll assume that you sell your shares just after you qualify for discount capital gain, so you sell your shares every 12 months. So this will enable you to have around $511 in 20 years if you start off with $100. And if you do the other way, if you don't sell your shares every year, you wait 20 years before selling it, and you pay a 50% tax rate with the discount capital gain, you will have around $530 if you start with $100. So it's still a bit more, but it's very close. So conclusion based on this analysis is that as long as you keep your stocks for at least 12 months if you are in Australia, you will do just as well as keeping your stocks for 20 years. From a tax perspective, this assumes that your rate of return is 10% per annum. What if you earn 20% per annum? If you earn 20% per annum, the money you have in 20 years, if you sell your stocks every single year, once a year, will be $2,311. On the other hand, if you wait 20 years before selling, you will have around $2,900. So the higher your rate of return, the bigger the benefit from delaying the payment of your taxes, and the more money you will have at the end if you wait a long time before selling your stocks. Alright, that's the end of today's video. I hope you found it useful and at least entertaining, if not useful. And have a lovely holiday. I'll see you next time.